Good morning, everybody. This is Hunter Satterfield, the Chief Investment Officer at Kane Waters and Associates, as well as one of the partners. As always, I am joined by my friends Brian Bortz, one of my fellow partners at Kane Waters, as well as the head of our investment committee, and Brad Sanders, the Managing Director of Tectonic Advisors. Gentlemen, lots to talk about this month because that was a wild, wild month. Before we get to it, this is your April market update. For the month of April, the S&P was off just 0.7%. It did not feel like that, so Brad will definitely talk about what happened there. Global stocks up 0.9%, domestic bonds up 0.4%, and then global bonds surging up 2.9%. So, Brad, before I come over to you, a couple broad numbers here, folks. First, the S&P is actually only off about 5% for the year, despite all the headlines. One of the things that we have talked about internally is how emotional this market is. So there's an interesting stat that was run toward the end of April that on days when the headline was Scott Bessent, the S&P was actually up for the day on average about 0.5% for the year so far. On the days when Howard Lutnick or Peter Navarro were the ones mentioned in the headlines, the market was actually off 1% on average per day for the year. So definitely an emotional market. The NASDAQ ended up, or so far year to date, is off about 10%. And one really interesting thing is international stocks are actually up 12% year to date, which certainly is trending sort of what we're seeing with global bonds. So a lot going on in the markets, and Brian will be talking a little bit about, are we out of this yet? But Brad, coming to you, seemingly there's no way we thought that the market was only off 1%, given the volatility in the month of April. You want to talk a little bit about what happened in the U.S. markets, and then also maybe a little bit of color on what's going on in the international markets that's causing them to surge so much this year?
Yeah, sure. Really, I think this just boils down to that was the longest month of my career, I think. I can't believe that was only one calendar month. Um, Maybe October of '08 probably would be rank up there. But I think it just boils down to when you inject this much uncertainty, um, there's really no way for the markets to function without a level of volatility that's going to be uncomfortable. If you just start running down, we don't have time to do all of it here, but prices are going to go up here pretty soon on a lot of stuff because these tariffs are going to kick in. You don't know how the consumers are going to react to that. A lot of earnings announcements are coming out. CEOs are pulling guidance. You don't know how the market's going to react to that. On down the list, and to your point on a podcast you had earlier this month, Hunter, we're all a tweet away from the market being up 5% too. So we're just going to have a level of volatility that's probably going to be pretty uncomfortable going forward. Really, I think the highlight from April and why the markets ended up only down 1% or so was because the bond market calmed down. There was a point, I think it was like April 9th. I was up really late tweeting all of you guys, or texting all of you guys, because there was a bunch of stuff happening in the bond market overnight that I did not like at all. High yield credit spreads had gone vertical. That's something I watch very closely. It's a pretty good indicator of stress in the credit markets. And while it didn't reach levels that, on an absolute basis, gave me pause, that the trajectory was not good. And to your point, Bessent came out the next day and calmed everybody down, and the bond markets were able to calm down. The 10-year Treasury yields like at about 4.1, 4.2 today. It touched 5 just in this calendar month, which is hard to believe that all happened in a span of 30 days. So if you can have the bond market acting orderly, it's going to keep us from having those days like we had in early April, where you have 2 back-to-back down 5% days, and just with the bond market acting orderly, that'll calm that down. But I think we just need to have a baseline level in our heads that we're going to have some good weeks and some really bad weeks coming up as the markets adjust all this, and as we get more clarity on what we're looking at going forward, because we just don't have that. We have very little more clarity today than we did on Liberation Day, if we were being intellectually honest about it. It's just all over the place. In terms of international, there's a bunch of stuff going on here. We started the year international has underperformed the U.S. by quite a bit for the last 5 years. So on a relative basis, those stocks are cheaper than domestic stocks. So from a value standpoint, they look pretty attractive, and that's why we continue to own them in our portfolios, albeit not as high as a weight as the domestic. And then you have the dollar weakening dramatically, and when you have the dollar weaken like that, it's going to make investing overseas look more attractive because you can basically sell dollars, go buy international stocks. They go up, you sell, then when you convert back to dollars, you have more dollars because the dollar's weakened. So that's driving a lot of that dollar movement. You also have, a lot of uncertainty with foreign investors where they're pulling money out of the US because of the policy shift and everything that's going on. International, while we like owning what we do own here, if you really start going country by country specifically, it's not a place where you would want to overweight in this environment. So it is, from a diversification standpoint, that has helped our portfolios. We glad we own it here. It's not somewhere that we want to go whole hog and be investing. If you start looking at countries like Germany and Japan and bigger countries like that are bigger weights in the international indices, they have issues as well that and their growth's not as high as we would like to be overweight in those portfolios.
Yeah, no, that's great. It is a good reminder of why we diversify and sort of allocate, because those would have been places we didn't want to be the last few years sort of in hindsight. But really good, obviously, to have an allocation going forward. Brian, just to come over to you, I alluded to this already, but I think given what we're seeing on earnings, which so far have been holding pretty steady at large, are we out of the woods here? Kind of what are you and the committee members, myself included, sort of talking through as we look at the next 60, 90, 120 days?
Yeah, thanks, Hunter. We always talk about how important earnings are. It makes me think of kind of two weather-related quotes. It's been raining a bunch here in Texas, so April showers bring May flowers, and it sounds like everything's going to be okay. But remember that May typically comes in like a lion and goes out like a lamb, and I think that's what we're seeing right now is the month of May is going to be really, really volatile. It's going to have a lot of roar to it, so to speak, and you think about retail sales, a lot of people are focusing on earnings and how good they are. And that is absolutely what drives the market. But understand that when you have retail companies that really only keep 6 to 8 weeks of inventory, a lot of that inventory is going to be depleted. And then this tariff policy is going to kick in. And, you're saying that you said not too long ago that, we're one tweet away from the market going up 5% or down 5%. I think we're going to see a lot of that this coming month. Good news is that we have seen a lot of that since Trump has taken office, and our portfolios have been extraordinarily less volatile than the market. And so, I want our investors and our clients to know that we have an eye on volatility as much as we do performance. And right now, our volatility looks really, really good because we're trying to protect and mute.
Yeah, no, that's great. Something that we've talked about on this recording, folks, is preparing for that volatility, and our portfolios are already there. So, Brian, thanks for those good words. Based on what Brian's saying, it's going to be an interesting May. So, as always, we will be back in front of you at the end of the month. Enjoy graduation season if that's upon you, Memorial Day as well, and we'll see you at the end of May. Thank you so much.